Good morning and welcome to today's investor webinar by Valory Resources. As you probably already know, Valory Resources is a very exciting Canadian met coal company focused on the development of hard coking coal projects to serve the global steel industry. And first of all, quick housekeeping items for today's event. It's a 1-hour webinar. Basically, it's been recorded, so if you miss anything, you can watch it again later to your heart's content. Please enter any questions you might have for the panelists via the control panel. And we'll try and get to your questions during the event. If we miss any questions today, we'll try and get back to you post-event, so please don't hold back on your questions. It's been recorded, 1-hour events will wrap up before 10 o'clock Queensland time. And also, I'd like to welcome to today's panelists. On the line today, we have the President of Valory Resources, Mr. Brian McDonald. Now, Brian is one of the world's preeminent experts in underground coking coal. There's Brian there. And Brian's in the middle there. So Brian has a very experience in underground coal mining. Former role include CEO and Chairman of Fitzroy Australia Resources, Managing Director of AMCI Australia, Managing Director of Valory Australia, and the CEO of MIM Holdings. What Brian doesn't know about underground coking coal mining probably isn't worth knowing. So Brian's a great guy to have on the team at Valory. And also down the left there, you have Vaughan Wishart, co-chair and CEO of Valory. Vaughan, again, civil engineer, more than decades experience in the industry. Previous roles included Stanmore Coal and at BHP's Olympic Dam. So some very big projects and very great knowledge in the industry. And on the right there, you have Glenn Vassallo, project finance and corporate. Glenn, really experienced in equity raising, debt raising, and project finance. Over $2 billion raised during his career. So some financing deals. Also very passionate, committed about his charity, which is a GRT Foundation, helping children in their communities, and the founder and chair of GRT Lawyers. So some great guys to have on the team here at Valory. And, so those are the guys on the team today. And now I'd like to hand over to Glenn to kick off the presentation. Thanks, Glenn.
Thank you very much, Anthony, and good morning to our Australian shareholders, and good afternoon to our Canadians. It's great that we can get together at this webinar. And as Anthony said, in terms of housekeeping, if there's some audio issues that you're experiencing, please send them through. We'll try to fix them up as we go, because what we're about to talk through is a very exciting set of milestones at the operational and corporate level for Valory Resources. So Vaughan, Brian and I look forward over the next 40 minutes to unpack each of those milestones as we work through our slide deck. Anthony, if you go to the next slide. And the next one. And we do this, ladies and gentlemen, in a very compelling backdrop where we are finally seeing the world waking up to the importance of metallurgical coal, which is what Valory is in the business of, producing coal for the steel industry. We all know that all the governments and the financial institutions have been talking about ESG, but people are starting to realise that one of the most important critical elements to that is metallurgical coal. And as you can see on that slide, steel is required for all the wind farms, the solar farms, the EVs that we all talk about with respect to this energy transition. So Valory is in this unique position to capitalise on what most people had forgotten about over the last 10 years, and we're very excited by that. And the economics are very compelling. As you can see, the metallurgical coal price on a per tonne basis is sitting at $324 a tonne. And we believe, with great fundamentals, that the economic unit for met coal will continue to strengthen, which puts us again in a very strong financial position. So if you could then, Anthony, please go to the next slide. As most of you know, Valory Resources comprises two key assets, an option to acquire Summit Coal, which owns Mine 14 from Maxim Power Corp, and it owns 100% of the Black Eagle Mining Corp as well. They're two wonderful projects in Alberta, and now I have the pleasure of passing over to your president, Mr. Brian McDonald, to talk through in more detail the operations of Valory.
Yeah, thank you. Next slide, please, mate. This is a This is a slide which looks at Western Canada, that is British Columbia and Alberta as the two dominant provinces on this picture. Those of you that are not aware, high quality coking coal, that is coal used for the carbon reduction of iron to produce steel, is dominantly found in three major basins globally that can access the seaborne trade. There's the Bowen Basin in central Queensland. There is the Appalachia Basinal Resource District in eastern US, and there's the Western Canadian Coal Basin. The former two are incredibly developed, where the resources have been increasingly exploited to their limit of economic extraction, particularly in the eastern US. And this particular basin, the Western Canadian Coal Basin, has been developed, known about since the 40s and 50s, but I think the global commodity for bulks, for seaborne traded steelmaking coal is now turning its attention very significantly to this part of the world as being a very, very significant portion for future exploitation. Over the last several years, I guess I've been working in this region and knowing around it since the early 2000s. As I was the CEO of MIM's coal business, we were extensively looking to merge and build businesses in this part of the world. Ultimately, that business was acquired by Glencore, and they put the focus on other regions. But there's been two dominant developments in the Western Canadian Coal Basin. This is all very relevant for Valory's positioning here and in the global context. In the southern part of that basin, there is a grouping of assets in the Kootenay Coal Resources field that's down around Elkford. Can you highlight that? Good on you. That's, yep, well done. Those 5 dots down there represent mines that were developed all by, major investments in the 70s and 80s, largely. A lot of investment by Japanese and Korean steel mills and European producers, and that is what used to be the Teck operations. Before that, they were called Fording Coal. And those of you that are aware, in the last 2 weeks, following several months of activity, Glencore has finally acquired the majority interest in those assets, and we'll talk about that. They produce a very high quality premium low vol coking coal, so it is the premium coal to produce steel. In the northern part of the basin, over the last several years, and again, if you can circle that so people can see that, that's called the Peace River Basin, and a privately owned company called AMCI, through a wholly owned subsidiary Conuma, has been acquiring all of the previously developed mining projects in that part of the basin that had been put on care and maintenance when the coal price went through its doldrums, on a couple of cycles ago. Now you can see that the basin, as you cast your eye on it, it's dominated then by 2 players, AMCI in the north, and there's undeveloped Glencore assets there as well, and Glencore in the south. These are 2 incredibly savvy and incredibly strategic long-term players in this industry, and it's no secret, and it should be no surprise to those savvy investors that they're there for a reason, and they're because of the dynamics of this basin and the fundamental advantages that it now has internationally. The 2 green projects there are Mine 14, which is the very near-term permitted project that Valory controls near a town of Grand Cache, and we'll talk about that in a sec. And the other one is a Blackstone project. It's fair to say that the target for these 2 projects, is a business on those 2 projects alone of a scale of 5 to 10 million tonnes per annum of reasonably foreseeable product getting into the market through the ports down in West Shore in Vancouver. The green lines are the dominant rail lines, so they serve both projects. And there's a reasonably near-term development horizon. So it's an incredibly prospective area, and these are really strategic positions in the basin itself. So next slide. A couple of things that are to note on this, and you'll all get copies of this, of course, but we're talking about premium, high-quality metallurgical coking coal. So this is not thermal coal used to raise steam or for power, and it's generally of a nature where its depositional environment is tectonic rather than heat. So it's dominantly high CSR, what's called coke strength after reaction. In other words, when you make the coal into coke, it's got high strength and it holds the burden up in a blast furnace very well. That's rare. Globally, it's rare. It's found in certain parts of the Bowen Basin only, not all of it, and it's found in certain parts of the Appalachia, not all of it. So it's a really important, and it means that it's a key blending substrate of almost all sort of coke oven blends that steel producers can use. I think everyone's very aware of the market demand. I mean, steel. Anyone that looks at it can get a pretty quick understanding that the demand for steel is not likely to drop off anytime soon, and there's simply not a market commentator that doesn't have a 2 to 5% increase on seaborne on steel production globally out 30 to 50 years. The thing that's really important about this basin is it's got really good established infrastructure, the rail networks in particular. This is a bulk commodity, so it lives and breathes on its logistics and being able to access the market. The rail network is incredibly strong. The port has it's under capacity, so it's got installed capacity well in excess of what its current throughput rates are. In Alberta in particular, and I want to point out that Valory's business is dominantly in Alberta at this stage. I wouldn't say that as we grow the tenement portfolio and look to acquire other interests, that it will always be in Alberta, but Alberta is the dominant region that particularly you can see the growth if you look at the undeveloped nature of the basin. It's mostly developed in the north and south. There are some reasons for that strategically, and most of those are infrastructure related, but the infrastructure now is across and throughout the rest of the basin, so there's no impediments to that. Unlike other parts of the world, it operates 52 weeks a year, and you particularly look at the disruptions that regularly occur in the cyclone season in Australia, or in the mountainous regions of Canada, for that matter. Valory's operations are mostly on the eastern side of the Rockies, so that they're not subject to the same issues that others do get impinged by. There's incredible community support, and Vaughan will talk a bit about that later in the presentation. We will also talk about the royalty regime that the Alberta state government is fully aware of the advantage that offers for their growth. Now, the other thing to point out in this part of the world, and it's very dominant, is that this is a culture in Canada, and it's a region that has incredibly strong Indigenous support. It's a much greater part of that society than perhaps in any other country of the world. And they're regionally based, and therefore the desire to inclusively support the Indigenous population in workforce, employment opportunities and advancement in education, offers significant, state and federal support, which is incredibly important for, resource development. And you can see that right throughout how Alberta in particular has grown, particularly in the oil sands up north and in the oil and gas, in the Western Canadian sort of sedimentary basins. Next slide, please. I just want to point out some of the aspects of the Glencore transaction, because I don't really believe the market globally has woken up to why that's so significant. And if you think about what I covered 2 slides ago on the basin itself, the strategic position that Teck has offered internationally is incredibly critical, but it's a portent to the basin's importance globally. The metrics here just demonstrate that Teck's acquisition by Glencore was at a value of a capital intensity of $400 million US per annual tonne of production for their economic share. You will see elsewhere in this that Mine 14, which is a very near-term permitted project to, it's entirely feasible that coal will reach the market during the course of the next year for this project. It's a 150 million capex for what is effectively a 1 million tonne project. And that of itself is 150 million per annual tonne of production, so it's 2.5 times less. There is startup project risk and execution risk with this, not existing cash flow, so there's a reason for there being a disparity. But Mine 14's intensity, the resource and present reserve, which is incredibly underexplored, it'll easily produce between 1 and 2 million product tonne, and that capital intensity therefore drops even further. So as an entry cost to accessing, what is an incredibly important bulk commodity into international seaborne trade, it represents a pretty low cost point of entry, and really attractive, project even of itself, at that scale. Next slide, please. The project itself, just to give you an idea, the area around this particular Mine 14 lease has been mined consistently underground and open cut since the 1940s. It really rose to prominent position in the 1980s when it started to be a significant export opportunity. Those of you that have watched Canada for some years will know that the area immediately to the top left of that picture, on the right-hand side of that screen, it used to be called Smoky River. It subsequently was acquired by various Asian interests. It's now known as CST Canada. That particular area, in multiple ownership since the 40s, has produced, hundreds of millions of tonnes of prospective project and actual coal for both domestic and export use. This particular reserve was always part of the larger resource in the region. It's a 100 to 200 million tonne opportunity of total coal inventory. It's not been properly explored in terms of its full extent. So the reserve that's over it in a compliant North American reserve, NI 43-101 is just under 20 million tonne. There's a permit, because the mine's permitted. It's a lease. There's a permit at 1.3 million tonnes a year, and it's about a mid-70s% yield. So that'll produce a 1 million tonne product. So this is, and essentially where you see on the map Mine 14 project, that's the point of entry of the coal. Essentially that mountain that is all around that particular heading, the lease is directly underneath that entire mountain. So I think the next slide or two shows. Just go to the next slide. The infrastructure, which is immediately to the valley on the opposite side of the mountain where the coal is underneath, has been exploited and fully developed, for many decades. There's been an existing coal-fired power station for domestic use that's been converted to gas over the last, decade. And there's an existing export facility, which is the mining infrastructure for the CST operation. They currently produce about 1 million tonnes of coal to export a year. It all goes to China. It's a Chinese-owned business, but it's got a capacity of 4 to 5 million tonnes. The infrastructure for Valory's Mine 14 project is fully permitted to locate a new prep plant on the opposite side of the gas-fired power station, and it's immediately adjacent to the existing rail line. So it's a very simple exercise of erecting the coal handling and preparation plant, the receival, crushing and screening and processing facilities, and building a direct conveyor over the rail line to load coal trains, and you're straight on the existing CN rail network to get out through Vancouver, accessing the global market. So there's all of the infrastructure needed, to develop this project in situ already, and its access to market, is virtually guaranteed through those approvals that are already in place. The other thing that's really important about the infrastructure here is that Grand Cache as a township was once a much larger town when the mine adjacent it was a much larger business. Power and water and schooling and housing and police and ambulance and medical, all of the social infrastructure for the development of the mine exists and is not required to be put in place by, you know, Valory or even at Mine 14 at a much larger scale. So it's on the back of, you know, really co-located, you know, significantly, you know, strategic infrastructure that the business can be developed in a reasonably capital efficient way and can get underway pretty quickly. Next slide. I won't talk much about this. I mean, it's well documented. You know, West Shore's a very good coal terminal. There's an agreement in place already.
It's a different slide.
I've got a different slide on my screen. Okay, so your screen's got the Mine 14 itself. This is a picture on the right-hand side of the coal prep plant. It's a notional picture that was produced some time ago. There's alternate solutions to that already. I've spoken about the basin before and its coke strength. Coke strength of 70 is pretty rare around the world. At a low volatile matter of sort of, you know, in the low 20s. This is a premium low vol PLV, meaning premium low vol steel making coal. I don't think there's any disputation about that. It's a premium product. The product from the particular seams being mined has been mined from the area before, so it's well known and used in the market already. And there's still some significant upsides in further characterisation of the coal quality and processing and the likes when we get into a little bit more detail during the early part of this next year. Sorry about the slide confusion. Next slide. I need to look at a different screen. West Shore was what I was talking about. The project already has 1 million tonnes per annum fully locked away of logistics capacity through the port. That matches its 1.3 million ROM tonnes per annum throughput at a mid-70s yield. So, you know, the logistics supply is pretty much locked away, and I'll cover rail later in the presentation as well. Next slide. You know, so in terms of people, I'll let you have a read of all of that, you know, at some stage later to work out the organisation. We are putting together and have put together already a very significant, experienced, enough grey hair in the room to have had bad experiences to have learned from. And you've got to remember these are underground coal mines, so yeah, execution and experience is incredibly important. Strategically, we've acquired the services of Scott Stendred, who has been the coal prep plant manager and general manager of the adjacent mining operation. He's worked there his entire life, sort of for 30+ years. Really strategic acquisition from a managerial perspective, knows the coals, knows their value and use, and incredibly important for the local community. And there's several other parties that we intend to pick up over time. I'll just move on from that slide. In terms of milestones, I guess there's a couple of things that I'd point out. At a very personal level, I've looked at this basin for probably greater than 20 years and had the opportunity to participate in a few, you know, startup opportunities, particularly around 2012, 2014, when the coal price was high and there were lots of Australian businesses interested. Valory's probably unique. You know, it's not yet public, so there's obviously a very significant value opportunity for folks to dive in, you know, at a early stage, you know, and get what is ordinarily the value uplift of new project development, plus also private to public, you know, transitions. But in terms of putting a foot in the ground and getting a strategic holding in the basin, Mine 14 represents the only project that is actually fully permitted and in its final phases of getting its last approvals, which are expected to be granted early next year. So that is actually really strategically important for the whole of the Western Canadian coal basin. And then Blackstone, which we haven't spoken about, we'll talk about in a sec, represents an incredible upside to the business. So, you know, we started conversations, you know, with Valory folk, Vaughan and Glenn more than a couple of years ago now. And I guess, you know, if you want to, you know, any sort of understanding of the significance that I place on this particular project and the business we've reached agreement to actually co-develop and run the business and grow it. There's no better example I can give to you of conviction, and I'm not putting pink lipstick on a pig. You know, I've been around this industry for my entire working life. These are really reasonably good assets to build a business around, and importantly, the quality characteristics of the coal make it stand out. You know, in a crowd where you'll always find a place in a market, and there'll be high demand. There's a whole lot of aspects that are important in all the ticks in the boxes in the bottom of that page. What I didn't cover before when talking about the logistics downstream was there's a rail contract we have in hand, ready to be executed. It's in the final phases of dealing with its negotiation and negotiated aspects, and that's about us trying to optimise our capital spend timing for the project. There's a lot of conversations going on with strategic investors and offtake parties, given the demand for this coal internationally and the timing that it's likely to reach the market. The rest of that page you can look at. In the interest of time, we can move forward. One of the things that I want to highlight, and you know, for the last 20 years, starting with Barlow Yonker and then looking at, you know, all of the other industry analysis, and now Woodmac that many people sort of place stock and trade in. And indeed, if you go to, you know, bulk commodities in iron ore, or you go to metals, everyone looks at typically what they call their C1 cost structure, which is a method to try and, you know, compare the competitive advantages of one project versus another globally on the basis of its raw unit cost of operations. Being a bulk commodity, everyone measures it on an FOB, free on board basis, and typically on a USD basis, given that's the dominant currency for the sale of the commodity. So the graph on the left-hand side is a graph that seeks to run real data from current releases from industry participants. So there's Anglo, there's Coronado, that's their publicly released accounts. There's South 32, which is their Illawarra undergrounds. There's Teck, which is all of their public released accounts. And then the recent sale of, you know, Daunia and Blackwater, publicly available information that they released was at those sort of numbers. You could run a Woodmac graph and so forth, but you'll see that the Canadian operations are middle of the road on the global cost curve on a non-royalty inclusive basis. And this goes to the really anti-competitive nature of the royalties that have been imposed by successive governments, particularly Queensland in Australia. Queensland, remember, is the dominant source of global seaborne traded, you know, metallurgical coking coal. When you put a reasonable number for revenue, and note 7 on that slide says that was based on 280 US over the last couple of years, you'll see how the Canadian operations, which are typically a 7% royalty before you know, pay your capital off effectively, and then they run to 13%. You'll see that the Canadian operations, on a real investment return basis, you know, you got to pay royalties before you take dividends out. They all move to the low end of the cost curve. Okay, they all move to the low end of the cost curve, and by far. So even that's at 280. At 320, most of the Queensland coal producers are in the upper bracket, which is, you know, an enormous tax take. And those graphs on the left-hand side of Anglo, Daunia, Blackwater, Coronado, those lines jump up to above 250 pretty quickly. And so, you know, there is a significant competitive advantage, and there's no secret why Glencore, they didn't announce it, but I think every punter on this call will easily recognise that that's a strategic move by Glencore into low-risk open-cut assets that are at the bottom end of the cost curve tax-wise and globally. And so Canada, there's no better indicator to you as investors that, you know, looking to get into, you know, what is a relatively high demand, you know, rare, high value commodity as a bulk commodity. Canada will be the dominant low end of the cost curve producer for the foreseeable future. and that's one of the reasons why the West Canadian coal basin dominantly is advantageous, and why Valory, as a pure met coal play, is an incredibly interesting, opportunity as a business. And I think those slides really speak for themselves. And that's not a hard sell, they're facts, okay? Next slide. There's a couple of things here that are worthwhile pointing out. Blackstone, which was the second project that identified in the basin, and it's sort of halfway between the major centres of Calgary and Edmonton. Anthony, you go back sort of 5 or 6 or 7 slides to the basinal map, please, mate. I just want to point it out for people. Next one back. Okay, so Blackstone is in Alberta, so it's in an incredibly favourable jurisdiction. It's halfway between Calgary and Edmonton, which are the 2 largest regional cities. It's in the prairies, so it's not in the mountains, and that's a really important aspect for this project. It's a massive resource by comparison with other resources available or that are potentially permittable in Canada. It's measured at sort of 500+ million tonne, but the inventory is probably over 1 billion. And it's a dominant basinal structure of coal, which is entirely unexplored, but represents a really significant opportunity. It's not inconceivable that the Blackstone project could see 2 or 3 economic developments for its entry. It's at least a significant single underground mine, but it could be multiple. Importantly, it's got access to infrastructure, and strategically, it's very critical. Go back to the slide that had Brian Jean on it, please, mate. Brian Jean is the Minister for Energy and Minerals in Alberta. Blackstone is already got a resource in JORC of +200, but I've got to caution folks, its inventory is vastly significantly larger than that. You'll know that you can only run a JORC statement where you put a borehole, and there's seismic and other indications of depositional coal across this contiguous resource lease, which is very large. This is an underground coal mine opportunity, which importantly, in Alberta, there's a very distinct or very significant distinction in the political framework and the regulatory framework between what is seen to be mountaintop open cut mining, which those of you on the phone call will appreciate the dominant media around a project like Grassy Mountain and all the negative publicity for the ranchers and the like. So this is not in the mountains, this is in the prairies, and this is underground. So its surface expression will be very small, and its disturbance will be inconsequential, but its employment opportunity and royalty and other advantages for Indigenous and community are really significant. So I guess there's real strong conviction that Blackstone presents perhaps the next opportunity for permitting in the state. And so on the strength of Mine 14, which we expect will be permitted early next year and developed immediately thereafter, Blackstone's probably the next one on a track record for a company like Valory to run. The next slide, please. You will see from the dominant cross sections on borehole and seismic runs on the right-hand side of that screen that it's a basin. It's a basinal resource. It's got some structural tectonics on its eastern margin where there's a propensity of holes, but in the central part of the syncline, through where you can see the dish-like elements of the coal seam, it's relatively benign, and it's all in treed prairies. So this is a really global scale sort of project development for a business like Valory. So it makes sense for the business to start up in a project like Mine 14. It's relatively small scale. It's a board and pillar operation. It's a really good scale of a business to get started, while it then uses that cash flow to do the balance of the exploration in this business. and then opens both up and runs the two as you know, blending capacities for different coal and amelioration of risk via multi-seam, multi-source operations, and it really makes a lot of sense strategically. Next slide. I'm going to pass over in part to Vaughan and Glenn in aspects of this and some of the next slides, and you'll stop hearing from me until perhaps questions. But you will see that in first quarter of next year, it's envisaged that the mine permit will be finalised. We've got the last round of negotiations with the Alberta Energy Regulator underway now. That's likely to, well, it's not like, it's highly likely to be finalised, and then the option will be exercised to acquire Summit Coal. And then underway already, I mean, we are already underway with the advanced engineering for mine site access. People are in the US this week looking at second-hand mining equipment that we're going to option and put in place for refurbishment to get to site. We're already started the pre-employment arrangements and aspects associated with the engagement of the workforce. There's strong agreements in place with Indigenous groups locally. We are negotiating already to acquire, as part of the option for coal processing, a second-hand prep plant to bring in to get started early, although there's, you know, the baseline is to build a new plant. And so, you know, there's a whole bunch of execution and project delivery aspects that are already being undertaken on the project. It's not inconceivable that washed product coal will be produced in the last quarter of next year if the permitting process is undertaken in the first part of the year, in the first quarter, and dealt with. I don't know of another project as a new start that has that avenue available to itself, and you know, there's a very good likelihood that all of that's, you know, absolutely achievable. I think at a mine site level, you know, the raw coal will at least be easily produced by the third or fourth quarter of next year. It's just whether the options for the plant come off in that same period of time, and that's what we're working to solve and mitigate risk for already. So, you know, it's a near-term project in every sense of the word, in a really strategic basinal environment. The bookends of that outcome is, you know, coal being produced anywhere between Q4 of 24 and, you know, back end of Q1 25, but it's not mid to late 25. It's certainly much shorter than that on a realistic basis. Probably hand over back to, what's the next slide? Okay, I'll talk to some of this. We become involved in the project only in the last 3 months, and you know, Vaughan and Glenn and the team that they'd had on this for some time were already achieving really significant gains with infrastructure, that is logistics and all of those other really key aspects. You know, as I've pretty much articulated during the course of this presentation, a lot of the advanced engineering is now done, and you can read all of those dot points as you go down the page. Those are the things that have been done since the last equity round, which was 2 or 3 months ago. And you can see that there's really a head of steam. Excuse me. You can see that there's a head of steam now in a whole range of aspects that are all in parallel. Most of those are execution phase issues on the strong expectation that the mine will be fully permitted, and funding will therefore be dealt with in the first quarter of next year, or by at least the end of the first quarter, and we'll be off to the races, developing the infrastructure and grabbing the people and starting to get out to get the mine developed. There's a lot of optimization studies also being done. There's a lot of value engineering options with this project to reduce the capex and or bring the project in sooner than what had always been envisaged. But you know, those are things that you can read in the balance. So we'll get to the next slide. Vaughan and Glenn.
Glenn,
yeah, thanks very much, Brian. So as we've said from the start of, particularly when I got involved, that the Valory capital management plan was always going to be a dual track process. Given the small amount of capex, as we describe it, for production of Mine 14. And that dual track process obviously involves running in parallel with an IPO path. Both of those paths are working in parallel, and as you can see there, that we're lining up for, from an IPO perspective, a pre-IPO round that's going to involve the issue of convertible notes leading into an IPO, which we think logically, assuming a few things fall into place, could be an option for the company around November next year. And we're very pleased to say that as part of the strategic process, which I'll speak about in a second, that involves financial institutions and brokers who are sending us their mandates, and we're close to finalising those to coincide with the IPO path. Running in parallel with that, as we've discussed, we formally commenced our preferred strategic selection process at the back end of October, and I'm very pleased to say that is too running extremely well. Anthony, if I could get you to change slide. So you'll see as far as the breakup of the capital management plan, one is the strategic selection process. We have 10 different strategics who have signed NDAs and who have had a series of presentations from Brian, Vaughan, myself, in relation to them doing their due diligence. And as we flagged from the start, that selection process will be a combination of considering which is the best end user, or alternatively, which commodity trader or mining operator that we're going to work with, as well as which financial institutions. I'm very pleased to say, as we've flagged throughout this presentation, that there is going to be no issue whatsoever to sell the product. I mean, the good thing is the Valory business sells a product that is in extreme demand, and each of the end users have said that they want to take the full product load. So we've just got to balance that up and mix the combination of the strategics together, and we're going to continue to work through the proposals to achieve the optimal outcome for shareholders, which is the best value. With respect to that, from a strategic perspective, that may be the path that enables us to complete the CapEx program on a private basis and further de-risk the Valory business prior to listing. Valory is a capital-hungry business, as you'd expect, as we've just outlined the strategic vision that we have going forward. And we do see that there's a logical timing for a public markets play for Valory as well. And we also want to create that a liquidity event for our shareholders have been very supportive. And we see that from an equities market perspective. As we know, the equity markets have been very quiet over the last 12 months. And you know, I think that when you overlay some of the global dynamics with respect to perhaps US inflation starting to become more manageable, there's an expectation that equity markets will be quite strong for next year. And we're going to be well positioned from a company perspective to take advantage of that, should we all decide that that's the optimal path for capital. And that listing obviously looks at what are the valuation metrics and methodologies that we can extract through the ASX. As Brian announced, and as we're aware of, the Glencore transaction involves the financial metrics that Brian outlined to you, but from a corporate perspective, it's the acquisition, but Glencore have also committed to spinning out their coal assets, and the current narrative from Glencore is that they're going to be well supported in the London market and the Toronto exchange. So we're going to keep our eye on how those metrics play out, and they've got a commitment to do that within a window. At this stage, it's a 2-year window, but we'll keep an eye on their valuation metrics, because they'll be a good indicator from a comparable point of view, together with some of the Australian comparable companies as well. So two of those paths are running exceptionally well. Vaughan, did you want to add anything in relation to that part?
Have we explained that step one involves raising 150 million US? That's the relatively small number for Mine 14. And we've got extremely strong interest to date from global strategic partners that are keen to put in either 50 or 100 million of that 150.
Yeah, so in terms of keeping Valory private, certainly the strategics that are in the data room and doing the due diligence can certainly write check themselves for 150 million. The full CapEx program, which is the full CapEx program, meaning that we're going to raise the full CapEx for production, post-production, and we're not going to keep ourselves or come up with a capital management plan that's going to require us to go back to market as 150 million USD for full production. And that's a combination of equity, debt, or other arrangements which we can do with some of the different strategics, whether that be a prepay or something similar. So that's definitely on the right path, very strong interest. And from a company perspective, you know, we really want to take the opportunity as we get closer to this catalytic event of unlocking the full equity value for Valory shareholders. There's two aspects to it. Obviously, is the Mine 14 opportunity, but as Brian's mentioned, is the Blackstone, and that's a very significant equity unlocking event that we see happening over the next 12 months. As you will be aware, we've not placed any equity value on Blackstone, and we don't intend to do that just yet, at least in the next month or two. But we do see that over the next 6 months being factored into our economic equation when we're sort of pricing Valory stock. Okay, so the Blackstone project, because of the things that are happening in Alberta, will give us the opportunity to unlock that. And when that does, it'll be a significant uplift for equity holders. So we are very pleased to provide you with this announcement that we want to put the foot down on Mine 14 and Blackstone. We are going to open up another round for our shareholders to participate in a issue of shares. We're going to raise a minimum of $2 million. We're going to open that up today, and that's going to be provided as an opportunity for our existing shareholders to come in at the Valory share price of $2.20 per share. Brian, did you want to talk about the use of funds?
Well, it depends on how much is raised, doesn't it? So priority right now is on completion of all of those pre-engineering works that optimise outcomes, so that when the permit is granted, we have packages ready to commence work immediately on aspects which are time critical for the critical path of first coal. That's that's the greatest value delivery outcome for the company. There's a bunch of dot points down there, as you can see. We've already captured the office. We're about to do the scopes of work for training facility. There's a large community engagement and workforce training aspect associated with this. Those of you on the call are probably aware that the only operating underground coal mine in Canada closed last week. That's over in Nova Scotia. That's owned privately by the remnants of the Klein Group. And the last operating underground was producing, in fact, in Grand Cache in 2015. There's the remnants of that workforce still around, but there's a large element of training of folks to come into this, and that actually presents a strategic opportunity, not a weakness for Valory. As the first mover in this field, it's going to end up with a significant workforce of skilled, trained and qualified and statutory qualified personnel, which is an impediment to other folks to enter the business in the region. The critical aspects in time-wise is a duality of the wash plant, and there's a couple of pathways to that, and the access road, and there's a couple of pathways to that. And I guess the use of the funds is on getting those things scoped out in a way that we can execute them, as early as possible.
Thanks, Anthony. Next slide. So just recapping, so we're opening up the minimum subscription for $2 million with the rights to take overs to existing shareholders.
That hasn't changed.
It's up there.
Okay.
Yep. For $2.20 per share. And as Brian explained, the use of funds as set out there, moving ahead with the projects and opening up the Grand Cache office. In terms of the existing capital structure, I'll just quickly touch on that. Next slide, Anthony. So we've got 54 million shares, 321,518 shares on issue, and they're the details of the share offer. which we've explained, and I'll let you digest those terms. And Anthony, we're happy to take some questions.
Great, thank you very much, gentlemen. That was awesome. Thank you again for your excellent presentation. And a few questions have come in, but everyone on the call, please feel free to submit more questions. We've got about 10 minutes left, so pretty tight for time, but any more questions, now's your chance to ask the team. Now, Brian, just a question that's come in here. The type of product Valory is going to produce at Mine 14, obviously after completing the acquisition, and at Blackstone, where do you see that fitting within the global steel industry?
Good question. The Canadian coals have always, well, particularly the premium coals, I mean, they produce a bunch of PCI and semi-hard coal as well, particularly from the Peace River Basin in the north. But the premium coals from the central and southern parts of the basin have always been dominant centerpieces of blending arrangements for all of the Asian, markets. Canadian coal's always been the, swing producer to the Australian coals. Customers dominantly want Canadian coals in their mix so they can, hold Australian producers to ransom in their price negotiations for offtake. And so there's always, and because the coals are so complementary, in the base centre part of the, I mean, there's a whole range of coals that go in to make a coke oven blend. Canadian coals can sit smack in the middle of that blend mix and can be basically able to be blended with most other coals. They're relatively low reactivity, and good coke strength. So they fit right in the middle, and therefore they don't suffer what other perhaps individual regional coal quality aspects do of some projects. So Valory's Mine 14 project is reasonably well known, and it's already, those seams have been mined and produced and sold globally already. So there's that element of execution risk is de minimis. Blackstone's still got a reasonable amount of exploration to go, but the early exploration on early stage slim core boreholes is that it's a high coke strength, and you go to any other project globally, the portent of an early stage indication like that means you end up with a very good coke strength when you get to bulk scale commercialized testing and mining. So it really is a good base blend of just about every coke make supply arrangement globally. So
Great, thanks, Brian. Question here about from a global met coal perspective. A lot's been said about the Queensland coal royalty increases recently. How are they relevant in terms of cost of production, and what's the impact on Valory?
Yeah, I think I covered that in the presentation. You may wish to go back to that slide with the cost curve elements on it, Anthony. That's it there. It's self-evident when folks construct any sort of model in their own capacities, what a sliding scale of royalties, which gets up to 40% of revenue, means to the cost of supply. I think the days are gone by where you can compare unit cost of operations globally on a unit cost basis excluding royalties, because if you're looking to invest into a project, the cost competitiveness of business has to be post royalties now. They're so very disparate globally between the eastern US to western Canada to Australia, between New South Wales and Queensland. There is a significant disparity, and it just basically pushes all the Queensland operations way up the cost curve. There's a positive for that for a project like Valory, is that that's the dominant volume of supply, and that means their costs are so high they won't be able to afford in a down environment a level of price that they would otherwise be able to absorb historically. And so it sort of puts a floor around what is a supply and therefore a revenue in the industry before they start shutting down volume to get a better balance. The other positive, of course, is that and you've seen in the Glencore acquisition, you know, capital goes to where it can get a better return, and there's no question that Canada is going to get a better return in the longer term at these sort of metrics.
I should just add too, Anthony, from a strategic selection process, there's no doubt that the end users and other big players strategically are looking outside of Australia now. I mean, the fact that the government imposed unilaterally those hikes in royalties, I mean, they had the ability to do that because it really wasn't at the time a genuine option. But as Brian alluded to, Brian Jean, who's now the Energy Minister in Alberta, is very pro-industry, and so too his other ministers. And they're really pushing the underground coal opportunity. And so we're probably one of the first to actually articulate this sort of economic unit breakdown, which I think will be a really important feature for why Valory sets itself apart from anything in Queensland.
The other aspect, Anthony, which is not part of this presentation, which is real, and this is not, you know, I hope the people on the call don't think this is an Australian bashing exercise, because it's not. This is just facts. Federally, in the Australian landscape for coal, a policy and a taxation regime has been brought in around greenhouse gas emissions. It's called the Safeguard program, and that is an effective level of taxation, particularly on underground coal in Australia, that is measured in the tens of dollars a tonne now. And it's very, very difficult for mines in Australia to be able to mitigate that CO2 production or CO2 equivalent production, particularly those gaseous methane, you know, underground mines in central Queensland. That it's nigh on impossible for them to mitigate. It just ends up becoming a cost of operations, another form of tax. So that's not reflected in these numbers, because that becomes something which is a burden on those businesses increasingly over this year, next year, the year after, and the year after, as they can't meet the thresholds that are imposed upon them. So,
Great, thanks, guys. Another question that's come in: what does Blackstone's development mean for Valory shareholders? So a bit about Blackstone.
I think I covered that in the presentation. It's a resource base which will handle, you know, because of the scale of the resource, it can handle a level of, if it's efficiently deployed capital, you could easily foresee that producing, you know, 5 to 10 million tonnes of itself or more, subject to the future exploration that needs to be done to prove up the balance of the resource base. It's a very good quality coal, so it's an order of magnitude larger on resource scale and hence exploitation potential than is the Mine 14 resource by itself. You know, it's a sort of opportunity for a company like Valory to get into Mine 14 first and get into production, build the market, build credibility, establish a workforce, and get cash flow generation. Blackstone becomes something then which is a really major stepping stone to reposition the business in a very different light. You know.
And in relation to that as well, just to supplement that, Anthony, is that from Blackstone, and again, what's relevant for shareholders is that the equity raisings that we're doing and the one announced today doesn't take into account the value of Blackstone. And the reason for that obviously is because of the current moratorium, but the change in government, particularly Brian Jean, has been extremely vocal in, you know, telling the world, and he's not being shy about it, that they're open to underground coal mining, metallurgical coal mining. So that puts us in a unique position because, as you know, a couple of other projects have been stopped, but they're all open cut. So we do see that together with the fact that, as everyone knows, which is in our shareholder updates, that that Valory has protected its rights with respect to Blackstone and instituted proceedings against the Alberta government, okay? And the court order has set some dates that require us to cross-examine some of the ministers, which obviously lends itself to crystallising an outcome that I think will be very favourable to Valory in unlocking Blackstone. In addition to that, there was a Supreme Court decision that came down in Canada, which actually slapped the federal government across the head around its overarching reach into the provincial level. Again, we don't have time to get into that today, but it's an advantage for Valory in terms of what it can do on a production side as well.